Note that by the end of 1994 the premium was reduced to $54.2 million. When this figure is added to Scott Fetzer's year-end book value of $94 million, the total is $148.2 million, which is the current carrying value of Scott Fetzer on Berkshire's books. That amount is less than half of our carrying value for the company when it was acquired. Yet Scott Fetzer is now earning about twice what it then did. Clearly, the intrinsic value of the business has consistently grown, even though we have just as consistently marked down its carrying value through purchase premium charges that reduced Berkshire's earnings and net worth. The difference between Scott Fetzer's intrinsic value and its carrying value on Berkshire's books is now huge. As I mentioned earlier, but I'm delighted to mention again, credit for this agreeable mismatch goes to Ralph Shea, a focused, smart, and high-grade manager. The reasons for Ralph's success are not complicated. Ben Graham taught me 4 or 5 years ago that in investing it is not necessary to do extraordinary things to get extraordinary results. In later life, I have been surprised to find that this statement holds true in business management as well. What a manager must do is handle the basics well and not get diverted. That's precisely Ralph's formula. He establishes the right goals and never forgets what he set out to do. On the personal side, Ralph is a joy to work with. He's forthright about problems and is self-confident without being self-important. He is also experienced. Though I don't know Ralph's age, I do know that, like many of our managers, he is over 65. At Berkshire, we look to performance, not to the calendar. Charlie and I, at 71 and 64 respectively, now keep George Foreman's picture on our desks. You can make book that our scorn for a mandatory retirement age will grow stronger every year. Intrinsic value and capital allocation. Understanding intrinsic value is as important for managers as it is for investors. When managers are making capital allocation decisions, including decisions to purchase shares, it's vital that they act in ways that increase per share intrinsic value and avoid moves that decrease it. This principle may seem obvious but will constantly see it violated. And, when misallocations occur, shareholders are hurt. For example, in contemplating business mergers and acquisitions, many managers tend to focus on whether the transaction is immediately dilutive or anti-dilutive to earnings per share, or, at financial institutions, to per-share book value. An emphasis of this sort carries great dangers. Going back to our college education example, imagine that a 5-year-old first-year MBA student is considering merging his future economic interests with those of a 5-year-old day laborer. The MBA student, a non-earner, would find that a share-for-share merger of his equity interest in himself with that of the day laborer would enhance his near-term earnings. In a big way. But what could be sillier for the student than a deal of this kind? In corporate transactions, it's equally silly for the would-be purchaser to focus on current earnings when the prospective acquiree has either different prospects, different amounts of non-operating assets, or a different capital structure. At Berkshire, we have rejected many merger and purchase opportunities that would have boosted current and near-term earnings, but that would have reduced per-share intrinsic value. Our approach, rather, has been to follow Wayne Gretzky's advice. Go to where the puck is going to be, not to where it is. As a result, our shareholders are now many billions of dollars richer than they would have been if we had used the standard catechism. The sad fact is that most major acquisitions display an egregious imbalance. They are a bonanza for the shareholders of the acquiree, they increase the income and status of the acquirer's management. And they are a honeypot for the investment bankers and other professionals on both sides. But, alas, they usually reduce the wealth of the acquirer's shareholders, often to a substantial extent. That happens because the acquirer typically gives up more intrinsic value than it receives. Do that enough, says John Medlin, the retired head of Wachovia Corp. And you are running a chain letter in reverse? Over time, the skill with which a company's managers allocate capital has an enormous impact on the enterprise's value. Almost by definition, a really good business generates far more money, at least after its early years, than it can use internally. The company could, of course, distribute the money to shareholders by way of dividends or share repurchases. But often the CEO asks the strategic planning staff, consultants or investment bankers whether an acquisition or two might make sense. That's like asking your interior decorator whether you need a $50,000 rug. The acquisition problem is often compounded by a biological bias. Many CEOs attain their positions in part because they possess an abundance of animal spirits and ego. If an executive is heavily endowed with these qualities which, it should be acknowledged, sometimes have their advantages, they won't disappear when he reaches the top. When such a CEO is encouraged by his advisors to make deals, he responds much as would a teenage boy who is encouraged by his father to have a normal sex life. It's not a push he needs. Some years back, a CEO friend of mine in jest, it must be said unintentionally, described the pathology of many big deals. This friend, who ran a property casualty insurer, was explaining to his directors why he wanted to acquire a certain life insurance company. After droning rather unpersuasively through the economics and strategic rationale for the acquisition, he abruptly abandoned the script. With an impish look, he simply said, "Aw, fellas, all the other kids have one." At Berkshire, our managers will continue to earn extraordinary returns from what appear to be ordinary businesses. As a first step, these managers will look for ways to deploy their earnings advantageously in their businesses. What's left, they will send to Charlie and me. We then will try to use those funds in ways that build per-share intrinsic value. Our goal will be to acquire either part or all of businesses that we believe we understand, that have good, sustainable underlying economics, and that are run by managers whom we like, admire, and trust. Compensation. At Berkshire, we try to be as logical about compensation as about capital allocation. For example, we compensate Ralph Shea based upon the results of Scott Fetzer rather than those of Berkshire. What could make more sense, since he's responsible for one operation but not the other? A cash bonus or a stock option tied to the fortunes of Berkshire would provide totally capricious rewards to Ralph. He could, for example, be hitting home runs at Scott Fetzer while Charlie and I rang up mistakes at Berkshire, thereby negating his efforts many times over. Conversely, why should option profits or bonuses be heaped upon Ralph if good things are occurring in other parts of Berkshire, but Scott Fetzer is lagging? In setting compensation, we like to hold out the promise of large carrots, but make sure their delivery is tied directly to results in the area that a manager controls. When capital invested in an operation is significant, we also both charge managers a high rate for incremental capital they employ and credit them at an equally high rate for capital they release. The product of this money's not free approach is definitely visible at Scott Fetzer. If Ralph can employ incremental funds at good returns, it pays him to do so. His bonus increases when earnings on additional capital exceed a meaningful hurdle charge. But our bonus calculation is symmetrical. If incremental investment yields substandard returns, the shortfall is costly to Ralph as well as to Berkshire. The consequence of this two-way arrangement is that it pays Ralph, and pays him well, to send to Omaha any cash he can't advantageously use in his business. It has become fashionable at public companies to describe almost every compensation plan as aligning the interests of management with those of shareholders. In our book, alignment means being a partner in both directions, not just on the upside. Many alignment plans flunk this basic test, being artful forms of heads I win, tails you lose. A common form of misalignment occurs in the typical stock option arrangement, which does not periodically increase the option price to compensate for the fact that retained earnings are building up the wealth of the company. Indeed, the combination of a 10-year option, a low dividend payout, and compound interest can provide lush gains to a manager who has done no more than tread water in his job. A cynic might even note that when payments to owners are held down, the profit to the option-holding manager increases. I have yet to see this vital point spelled out in a proxy statement asking shareholders to approve an option plan. I can't resist mentioning that our compensation arrangement with Ralph Shea was worked out in about 5 minutes, immediately upon our purchase of Scott Fetzer and without the help of lawyers or compensation consultants. This arrangement embodies a few very simple ideas, not the kind of terms favored by consultants who cannot easily send a large bill unless they have established that you have a large problem. And one. Of course, that requires an annual review. Our agreement with Ralph has never been changed. It made sense to him and to me in 1986, and it makes sense now. Our compensation arrangements with the managers of all or other units are similarly simple, though the terms of each agreement vary to fit the economic characteristics of the business at issue, the existence in some cases of partial ownership of the unit by managers, etc. In all instances, we pursue rationality. Arrangements that pay off in capricious ways, unrelated to a manager's personal accomplishments, may well be welcomed by certain managers, who, after all, refuses a free lottery ticket. But such arrangements are wasteful to the company and cause the manager to lose focus on what should be his real areas of concern. Additionally, Irrational behavior at the parent may well encourage imitative behavior at subsidiaries. At Berkshire, only Charlie and I have the managerial responsibility for the entire business. Therefore, we are the only parties who should logically be compensated in the basis of what the enterprise does as a whole. Even so, that is not a compensation arrangement we desire. We have carefully designed both the company and our jobs so that we do things we enjoy with people we like. Equally important, we are forced to do very few boring or unpleasant tasks. We are the beneficiaries as well of the abundant array of material and psychic perks that float over the heads of corporations. Under such idyllic conditions, we don't expect shareholders to ante up loads of compensation for which we have no possible need. Indeed, if we were not paid at all, Charlie and I would be delighted with the cushy jobs we hold. At bottom, we subscribe to Ronald Reagan's creed. It's probably true that hard work never killed anyone, but I figure why take the chance? Sources of reported earnings. The table on the next page shows the main sources of Berkshire's reported earnings. In this presentation, purchase premium charges of the type we discussed in our earlier analysis of Scott Fetzer are not assigned to the specific businesses to which they apply, but are instead aggregated and shown separately. This procedure lets you view the earnings of our businesses as they would have been reported had we not purchased them. This form of presentation seems to us to be more useful to investors and managers than one utilizing GAAP, which requires purchase premiums to be charged off, business by business. The total earnings we show in the table are, of course, identical to the GAAP total in our audited financial statements. Asterisk includes Dexter's earnings only from the date it was acquired, November 7,199.3. Asterisk excludes interest expense of finance businesses. A large amount of information about these businesses is given on pages 37 to 48, where you will also find our segment earnings reported on a GAAP basis. In addition, on pages 53 to 59, we have rearranged Berkshire's financial data into 4 segments on a non-GAAP basis, a presentation that corresponds to the way Charlie and I think about the company. Our intent is to supply you with the financial information that we would wish you to give us if our positions were reversed. Look-through earnings. In past reports, we've discussed look-through earnings, which we believe more accurately portray the earnings of Berkshire than does our GAAP result. As we calculate them, look-through earnings consist of 1. The operating earnings reported in the previous section, plus 2. The retained operating earnings of major investees that, under GAAP accounting, are not reflected in our profits, less 3. An allowance for the tax that would be paid by Berkshire if these retained earnings of investees had instead been distributed to us. The operating earnings of which we speak here exclude capital gains, special accounting items and major restructuring charges. If our intrinsic value is to grow at our target rate of 15%, our look-through earnings, over time, must also increase at about that pace. When I first explained this concept a few years back, I told you that meeting this 15% goal would require us to generate look-through earnings of about $1.8 billion by 2000. Because we've since issued about 3% more shares, that figure has grown to $1.85 billion. We are now modestly ahead of schedule in meeting our goal, but to a significant degree that is because our SuperCat insurance business has recently delivered earnings far above trendline expectancy, an outcome I will discuss in the next section. Giving due weight to that abnormality, we still expect to hit our target, but that, of course, is no sure thing. The following table shows how we calculate look-through earnings, though I warn you that the figures are necessarily very rough. The dividends paid to us by these investees have been included in the operating earnings itemized on page 12, mostly under Insurance Group, net investment income. $1030 $841. 1. Does not include shares allocable to the minority interest at Wesco, calculated on average ownership for the year. 3. Excludes realized capital gains, which have been both recurring and significant. The tax rate used is 14%, which is the rate Berkshire pays on the dividends it receives. Insurance operations. As we've explained in past reports, what counts in our insurance business is, first, the amount of float we develop, and second, its cost to us. Float is money we hold but don't own. In an insurance operation, float arises because most policies require that premiums be prepaid, and more importantly, because it usually takes time for an insurer to hear about and resolve loss claims. Typically, the premiums that an insurer takes in do not cover the losses and expenses it must pay. That leaves it running an underwriting loss, and that loss is the cost of float. An insurance business is profitable over time if its cost of float is less than the cost the company would otherwise incur to obtain funds. But the business has a negative value if the cost of its float is higher than market rates for money. As the numbers in the following table show, Berkshire's insurance business has been an enormous winner. For the table, we have compiled our float, which we generate in exceptional amounts relative to our premium volume by adding loss reserves, loss adjustment reserves, funds held under reinsurance, assumed and unearned premium reserves, and then subtracting agents' balances, prepaid acquisition costs, prepaid taxes, and deferred charges applicable to assumed reinsurance. Our cost of float is determined by our underwriting loss or profit. In those years when we have had an underwriting profit, such as the last two, our cost of float has been negative, and we have determined our insurance earnings by adding underwriting profit to float income. Charlie and I are delighted that our float grew in 1994 and are even more pleased that it proved to be cost-free. But our message this year echoes the one we delivered in 1993. Though we have a fine insurance business, it is not as good as it currently looks. The reason we must repeat this caution is that our SuperCat business, which sells policies that insurance and reinsurance companies buy to protect themselves from the effects of mega catastrophes, was again highly profitable. Since truly major catastrophes occur infrequently, our SuperCat business can be expected to show large profits in most years, but occasionally to record a huge loss. In other words, the attractiveness of our SuperCat business will take many years to measure. Certainly 1994 should be regarded as close to a best case. Our only significant losses arose from the California earthquake in January. I will add that we do not expect to suffer a major loss from the early 1995 Kobe earthquake. SuperCat policies are small in number, large in size, and non-standardized. Therefore, the underwriting of this business requires far more judgment than, say, the underwriting of auto policies, for which a mass of data is available. Here Berkshire has a major advantage. Ajit Jain, our SuperCat manager, whose underwriting skills are the finest. His value to us is simply enormous. In addition, Berkshire has a special advantage in the SuperCat business because of our towering financial strength, which helps us in two ways. First, a prudent insurer will want its protection against true mega catastrophes, such as a $50 billion windstorm loss on Long Island, or an earthquake of similar cost in California, to be absolutely certain. But that same insurer knows that the disaster making it dependent on a large SuperCat recovery is also the disaster that could cause many insurers to default. There's not much sense in paying premiums for coverage that will evaporate precisely when it is needed. So the certainty that Berkshire will be both solvent and liquid after a catastrophe of unthinkable proportions is a major competitive advantage for us. The second benefit of our capital strength is that we can write policies for amounts that no one else can even consider. For example, during 1994, a primary insurer wished to buy a short-term policy for $400 million of California earthquake coverage, and we wrote the policy immediately. We know of no one else in the world who would take a $400 million risk, or anything close to it, for their own account. Generally, brokers attempt to place coverage for large amounts by spreading the burden over a number of small policies. But, at best, coverage of that sort takes considerable time to arrange. In the meantime, the company desiring reinsurance is left holding a risk it doesn't want, and that may seriously threaten its well-being. At Berkshire, on the other hand, we will quote prices for coverage as great as $500 million on the same day that we are asked to bid. No one else in the industry will do the same. By writing coverages in large lumps, we obviously expose Berkshire to lumpy financial results. That's totally acceptable to us. Too often, insurers, as well as other businesses, follow suboptimum strategies in order to smooth their reported earnings. By accepting the prospect of volatility, we expect to earn higher long-term returns than we would by pursuing predictability. Given the risks we accept, Ajit and I constantly focus on our worst case, knowing, of course, that it is difficult to judge what this is, since you could conceivably have a Long Island hurricane, California earthquake, and SuperCat X all in the same year. Additionally, insurance losses could be accompanied by non-insurance troubles. For example, were we to have SuperCat losses from a large Southern California earthquake, they might well be accompanied by a major drop in the value of our holdings in Seas, Wells Fargo, and Freddie Mac. All things considered, we believe our worst-case insurance loss from a supercat is now about $600 million after tax, an amount that would slightly exceed Berkshire's annual earnings from other sources. If you are not comfortable with this level of exposure, the time to sell your Berkshire stock is now, not after the inevitable mega catastrophe. Our supercat volume will probably be down in 1995. Prices for garden variety policies have fallen somewhat, and the torrent of capital that was committed to their insurance business a few years ago will be inclined to chase premiums, irrespective of their adequacy. Nevertheless, we have strong relations with an important group of clients who will provide us with a substantial amount of business in 1995. Berkshire's other insurance operations had excellent results in 1994. Our home state operation, led by Rod Eldred, our workers' compensation business, headed by Brad Kinsler, our credit card operation, managed by the Kaiser family, National Indemnity's traditional auto and general liability business, led by Don Worster, all of these generated significant underwriting profits accompanied by substantial float. We can conclude this section as we did last year. All in all, we have a first-class insurance business. Though its results will be highly volatile, this operation possesses an intrinsic value that exceeds its book value by a large amount larger, in fact, than is the case at any other Berkshire business. Common stock investments. Below, we list our common stock holdings having a value of over $300 million. A small portion of these investments belongs to subsidiaries of which Berkshire owns less than 100%. Our investments continue to be few in number and simple in concept. The truly big investment idea can usually be explained in a short paragraph. We like a business with enduring competitive advantages that is run by able and owner-oriented people. When these attributes exist, and when we can make purchases at sensible prices, it is hard to go wrong, a challenge we periodically manage to overcome. Investors should remember that their scorecard is not computed using Olympic diving methods. Degree of difficulty doesn't count. If you are right about a business whose value is largely dependent on a single key factor that is both easy to understand and enduring, the payoff is the same as if you had correctly analyzed an investment alternative characterized by many constantly shifting and complex variables. We try to price, rather than time, purchases. In our view, it is folly to forego buying shares in an outstanding business whose long-term future is predictable, because of short-term worries about an economy or a stock market that we know to be unpredictable. Why scrap an informed decision because of an uninformed guess? We purchased National Indemnity in 1967, Sears in 1972, Buffalo News in 1977, Nebraska Furniture Mart in 1983, and Scott Fetzer in 1986, because those are theirs, they became available, and because we thought the prices they carried were acceptable. In each case, we pondered what the business was likely to do, not what the Dow, the Fed, or the economy might do. If we see this approach as making sense in the purchase of businesses in their entirety, why should we change tack when we are purchasing small pieces of wonderful businesses in the stock market? Before looking at new investments, we consider adding to old ones. If a business is attractive enough to buy once, it may well pay to repeat the process. We would love to increase our economic interest in Sears or Scott Fetzer, but we haven't found a way to add to a 100% holding. In the stock market, however, an investor frequently gets the chance to increase his economic interest in businesses he knows and likes. Last year we went that direction by enlarging our holdings in Coca-Cola and American Express. Our history with American Express goes way back, and in fact fits the pattern of my pulling current investment decisions out of past associations. In 1951, for example, Geico shares comprised 70% of my personal portfolio, and Geico was also the first stock I sold. I was then 20 as a security salesman. The sale was 100 shares to my Aunt Alice who, bless her, would have bought anything I suggested. 25 years later, Berkshire purchased a major stake in Geico at the time it was threatened with insolvency. In another instance, that of the Washington Post, about half of my initial investment funds came from delivering the paper in the 1940s. 3 decades later, Berkshire purchased a large position in the company 2 years after it went public. As for Coca-Cola, my first business venture, this was in the 1930s, was buying a 6-pack of Coke for 25 cents and selling each bottle for 5 cents. It took only 50 years before I finally got it. The real money was in the syrup. My American Express history includes a couple of episodes. In the mid-1960s, just after the stock was battered by the company's infamous salad oil scandal, We put about 40% of Buffett Partnership Limited as capital into the stock, the largest investment the partnership had ever made. I should add that this commitment gave us over 5% ownership in Amex at a cost of $13 million. As I write this, we own just under 10%, which has cost us $1.36 billion. Amex earned $12.5 million in 1964 and $1.4 billion in 1994. My history with Amex's IDS unit, which today contributes about a third of the earnings of the company, goes back even further. I first purchased stock in IDS in 1953 when it was growing rapidly and selling at a price-earnings ratio of only 3. There was a lot of low-hanging fruit in those days. I even produced a long report, do I ever write a short one, on the company that I sold for $1 through an ad in the Wall Street Journal. Obviously, American Express and IDS, recently renamed American Express Financial Advisors, are far different operations today from what they were then. Nevertheless, I find that a long-term familiarity with a company and its products is often helpful in evaluating it. Mistake du jour. Mistakes occur at the time of decision. We can only make our mistake du jour, however, when the foolishness of the decision become obvious. By this measure, 1994 was a vintage year with keen competition for the gold medal. Here, I would like to tell you that the mistakes I will describe originated with Charlie. But whenever I try to explain things that way, my nose begins to grow. And the nominees are: late in 1993, I sold 10 million shares of Cap Cities at $63. At year-end 1994, the price was $85.25. The difference is $222. $5 million for those of you who wish to avoid the pain of calculating the damage yourself. When we purchased the stock at $17, 25 inches 1,986, I told you that I had previously sold our Cap Cities holdings at $4.3 per share during 1978 to 80, and added that I was at a loss to explain my earlier behavior. Now I've become a repeat offender. Maybe it's time to get a guardian appointed. Egregious as it is, the Cap Cities decision earns only a silver medal. Top honors go to a mistake I made 5 years ago that fully ripened in 1994. Our $358 million purchase of US Air preferred stock, on which the dividend was suspended in September. In the 1990 annual report, I correctly described this deal as an unforced error, meaning that I was neither pushed into the investment nor misled by anyone when making it. Rather, this was a case of sloppy analysis, a lapse that may have been caused by the fact that we were buying a senior security or by hubris. Whatever the reason, the mistake was large. Before this purchase, I simply failed to focus on the problems that would inevitably beset a carrier whose costs were both high and extremely difficult to lower. In earlier years, these life-threatening costs posed few problems. Airlines were then protected from competition by regulation, and carriers could absorb high costs because they could pass them along by way of fares that were also high. When deregulation came along, it did not immediately change the picture. The capacity of low-cost carriers was so small that the high-cost lines could, in large part, maintain their existing fare structures. During this period, with the longer-term problems largely invisible but slowly metastasizing, the costs that were non-sustainable became further embedded. As the seat capacity of the low-cost operators expanded, their fares began to force the old-line, high-cost airlines to cut their own. The day of reckoning for these airlines could be delayed by infusions of capital, such as ours into US Air. But, eventually a fundamental rule of economics prevailed. In an unregulated commodity business, a company must lower its costs to competitive levels or face extinction. This principle should have been obvious to your chairman, but I missed it. Seth Schofield, CEO of US Air, has worked diligently to correct the company's historical cost problems but, to date, has not managed to do so. In part, this is because he has had to deal with a moving target, the result of certain major carriers having obtained labor concessions and other carriers having benefited from fresh start costs that came out of bankruptcy proceedings. As Herb Kelleher, CEO of Southwest Airlines, has said, bankruptcy court for airlines has become a health spa. Additionally, it should be no surprise to anyone that those airline employees who contractually receive above-market salaries will resist any reduction in these as long as their checks continue to clear. Despite this difficult situation, US Air may yet achieve the cost reductions it needs to maintain its viability long-term. But it is far from sure that will happen. Accordingly, we wrote our U.S. Air investment down to $89.5 million, 25 cents on the dollar at year-end 1,994. This valuation reflects both a possibility that our preferred will have its value fully or largely restored, and an opposite possibility that the stock will eventually become worthless. Whatever the outcome, we will heed a prime rule of investing. You don't have to make it back the way that you lost it. The accounting effects of our U.S. Air write-down are complicated. Under GAAP accounting, insurance companies are required to carry all stocks on their balance sheets at estimated market value. Therefore, at the end of last year's third quarter, we were carrying our U.S. Air preferred at $89.5 million, or 25% of cost. In other words, our net worth was at that time reflecting a value for U.S. Air that was far below our $358 million cost. But in the fourth quarter, we concluded that the decline in value was, in accounting terms, other than temporary, and that judgment required us to send the write-down of $269 million through our income statement. The amount will have no other fourth quarter effect. That is, it will not reduce our net worth, because the diminution of value had already been reflected. Charlie and I will not stand for re-election to U.S. Air's board at the upcoming annual meeting. Should Seth wish to consult with us, however, we will be pleased to be of any help that we can. Michel Lanios, 2 CEOs who have done great things for Berkshire shareholders, retired last year. Dan Burke of Capital Cities, ABC, and Carl Reichert of Wells Fargo. Dan and Carl encountered very tough industry conditions in recent years, but their skill as managers allowed the businesses they ran to emerge from these periods with record earnings, added luster, and bright prospects. Additionally, Dan and Carl prepared well for their departure and left their companies in outstanding hands. We owe them more gratitude. About 95.7% of all eligible shares participated in Berkshire's 1994 Shareholder Designated Contributions Program. Contributions made through the program were $10.4 million, and 3,300 charities were recipients. Every year, a few shareholders miss participating in the program because they either do not have their shares registered in their own names on the prescribed record date, or because they fail to get the designation form back to us within the 60-day period allowed for its return. Since we don't make exceptions when requirements aren't met, we urge that both new shareholders and old read the description of our Shareholder Designated Contributions Program that appears on pages 50 to 51. To participate in future programs, you must make sure your shares are registered in the name of the actual owner, not in the nominee name of a broker, bank, or depository. Shares not so registered on the 31st of August 1995 will be ineligible for the 1995 program. We made only one minor acquisition during 1994, a small retail shoe chain, but our interest in finding good candidates remains as keen as ever. The criteria we employ for purchases or mergers is detailed in the appendix on page 21. Last spring, we offered to merge with a large family-controlled business on terms that included a Berkshire convertible preferred stock. Though we failed to reach an agreement, this episode made me realize that we needed to ask our shareholders to authorize preferred shares, in case we wanted in the future to move quickly, if a similar acquisition opportunity were to appear. Accordingly, our proxy presents a proposal that you authorize a large amount of preferred stock, which will be issuable on terms set by the board of directors. You can be sure that Charlie and I will not use these shares without being completely satisfied that we are receiving as much in intrinsic value as we are giving. Charlie and I hope you can come to the annual meeting at a new site. Last year, we slightly overran the Orpheum Theater's seating capacity of 2,750, and therefore we will assemble at 9:30 a.m. on Monday, the 1st of May 1995, at the Holiday Convention Center. The main ballroom at the center can handle 3,300, and if need be, we will have audio and video equipment in an adjacent room, capable of handling another 1,000 people. Last year we displayed some of Berkshire's products at the meeting, and as a result sold about 800 pounds of candy, 507 pairs of shoes, and over $12,000 of world books and related publications. All these goods will be available again this year. Though we like to think of the meeting as a spiritual experience, we must remember that even the least secular of religions includes the ritual of the collection plate. Of course, what you really should be purchasing is a videotape of the 1995 Orange Bowl. Your chairman views this classic nightly, switching to slow motion for the fourth quarter. Our cover color this year is a salute to Nebraska's football coach Tom Osborne and his Cornhuskers, the country's top college team. I urge you to wear Husker red to the annual meeting, and promise you that at least 50% of your managerial duo will be in appropriate attire. We recommend that you promptly get hotel reservations for the meeting, as we expect a large crowd. Those of you who like to be downtown, about 6 miles from the center, may wish to stay at the Radisson Reddick Tower, a small, 88 rooms, but nice hotel, or at the much larger Red Lion Hotel a few blocks away. In the vicinity of the center are the Holiday Inn, 403 rooms, Homewood Suites, 118 rooms, and Hampton Inn, 136 rooms. Another recommended spot is the Marriott, whose West Omaha location is about 100 yards from Borsheim's and a 10-minute drive from the center. There will be buses at the Marriott that will leave at 8:45 and 9 for the meeting and return after it ends. An attachment to our proxy material explains how you can obtain the card you will need for admission to the meeting. A good-sized parking area is available at the center, while those who stay at the Holiday Inn, Homewood Suites and Hampton Inn will be able to walk to the meeting. As usual, we will have buses to take you to the Nebraska Furniture Mart in Borsheim's after the meeting, and to take you from there to hotels or the airport later. I hope you make a special effort to visit the Nebraska Furniture Mart because it has opened the Mega Mart, a true retailing marvel that sells electronics, appliances, computers, CDs, cameras, audio equipment. Sales have been sensational since the opening, and you will be amazed by both the variety of products available and their display on the floor. The Megamart, adjacent to NFM's main store, is on our 64-acre site about 2 miles north of the center. The stores are open from 10 a.m. to 9 p.m. on Fridays, 10 a.m. to 6 p.m. on Saturdays, and noon to 6 p.m. on Sundays. When you're there, be sure to say hello to Mrs. B, who at 101 will be hard at work in our Mrs. B's warehouse. She never misses a day at the store, or, for that matter, an hour. Borsheim's normally is closed on Sunday, but will be open for shareholders and their guests from noon to 6 p.m. on Sunday. This is always a special day, and we will try to have a few surprises. Usually this is the biggest sales day of the year, so for more reasons than one, Charlie and I hope to see you there. On Saturday evening, April 29, there will be a baseball game at Rosenblatt Stadium between the Omaha Royals and the Buffalo Bisons. The Buffalo team is owned by my friends, Mindy and Bob Rich Jr., and I'm hoping they will attend. If so, I will try to entice Bob into a one-pitch duel on the mound. Bob is a capitalist's Randy Johnson young, strong and athletic, and not the sort of fellow you want to face early in the season, so I will need plenty of vocal support. The proxy statement will include information about obtaining tickets to the game. About 1,400 shareholders attended the event last year. Opening the game that night, I had my stuff and threw a strike that the scoreboard reported at 8 miles per hour. What many fans missed was that I shook off the catcher's call for my fast ball and instead delivered my changeup. This year it will be all smoke. The 7th of March, 1995. Warren E. Buffett, Chairman of the Board, Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Incorporated, our gain in net worth during 1995 was $5.3 billion, or 45%. Per share book value grew by a little less, 43.1%, because we paid stock for 2 acquisitions, increasing our shares outstanding by 1.3%. Over the last 31 years, that is, since present management took over, per share book value has grown from $19 to $14,426, or at a rate of 23.6% compounded annually. There's no reason to do handsprings over 1,995's gains. This was a year in which any fool could make a bundle in the stock market, and we did. To paraphrase President Kennedy, a rising tide lifts all yachts. Putting aside the financial results, there was plenty of good news at Berkshire last year. We negotiated 3 acquisitions of exactly the type we desire. 2 of these, Helzberg's Diamond Shops and R.C. Willey Home Furnishings, are included in our 1995 financial statements, while our largest transaction, the purchase of Geico, closed immediately after the end of the year. I'll tell you more about all 3 acquisitions later in the report. These new subsidiaries roughly double our revenues. Even so, the acquisitions neither materially increased our shares outstanding nor our debt. And, though these 3 operations employ over 11,000 people, our headquarters staff grew only from 11 to 12. No sense going crazy. Charlie Munger, Berkshire's vice chairman and my partner, and I want to build a collection of companies both wholly and partly owned that have excellent economic characteristics and that are run by outstanding managers. Our favor acquisition is the negotiated transaction that allows us to purchase 100% of such a business at a fair price. But we are almost as happy when the stock market offers us the chance to buy a modest percentage of an outstanding business at a pro rata price well below what it would take to buy 100%. This double-barreled approach, purchases of entire businesses through negotiation or purchases of part interests through the stock market, gives us an important advantage over capital allocators who stick to a single course. Woody Allen once explained why eclecticism works. The real advantage of being bisexual is that it doubles your chances for a date on Saturday night. Over the years, we've been Woody-like in our thinking, attempting to increase our marketable investments in wonderful businesses, while simultaneously trying to buy similar businesses in their entirety. The following table illustrates our progress in both fronts. In the tabulation, we show the marketable securities owned per share of Berkshire at 10-year intervals. A second column lists our per-share operating earnings, before taxes and purchase price adjustments but after interest and corporate overhead, from all other activities. In other words, the second column shows what we earned excluding the dividends, interest and capital gains that we realized from investments. Purchase price accounting adjustments are ignored for reasons we have explained at length in previous reports, and which, as an act of mercy, we won't repeat. We'll be glad to send masochists the earlier explanations, however. These results have not sprung from some master plan that we concocted in 1965. In a general way, we knew then what we hoped to accomplish but had no idea what specific opportunities might make it possible. Today we remain similarly unstructured. Over time, we expect to improve the figures in both columns, but have no roadmap to tell us how that will come about. We proceed with two advantages. First, our operating managers are outstanding, in most cases have an unusually strong attachment to Berkshire. Second, Charlie and I have had considerable experience in allocating capital and try to go at that job rationally and objectively. The giant disadvantage we face is size. In the early years, we needed only good ideas, but now we need good big ideas. Unfortunately, the difficulty of finding these grows in direct proportion to our financial success, a problem that increasingly erodes our strengths. I will have more to say about Berkshire's prospects later in this report, when I discuss our proposed recapitalization. Acquisitions. It may seem strange that we exult over a year in which we made 3 acquisitions, given that we have regularly used these pages to question the acquisition activities of most managers. Rest assured, Charlie and I haven't lost our skepticism. We believe most deals do damage to the shareholders of the acquiring company. Too often, the words from HMS Pinafore apply. Things are seldom what they seem. Skim milk masquerades as cream. Specifically, sellers and their representatives invariably present financial projections having more entertainment value than educational value. In the production of rosy scenarios, Wall Street can hold its own against Washington. In any case, why potential buyers even look at projections prepared by sellers baffles me. Charlie and I never give them a glance, but instead, keep in mind the story of the man with an ailing horse. Visiting the vet, he said, "Can you help me? Sometimes my horse walks just fine and sometimes he limps." The vet's reply was pointed. "No problem when he's walking fine, sell him." In the world of mergers and acquisitions, that horse would be peddled as secretariat. At Berkshire, we have all the difficulties in perceiving the future that other acquisition-minded companies do. Like they also, we face the inherent problem that the seller of a business practically always knows far more about it than the buyer and also picks the time of sale, a time when the business is likely to be walking just fine. Even so, we do have a few advantages, perhaps the greatest being that we don't have a strategic plan. Thus, we feel no need to proceed in an ordained direction, a course leading almost invariably to silly purchase prices, but can instead decide what makes sense for our owners. In doing that, we always mentally compare any move we are contemplating with dozens of other opportunities open to us, including the purchase of small pieces of the best businesses in the world via the stock market. Our practice of making this comparison acquisitions against passive investments is a discipline that managers focus simply on expansion seldom use. Talking to Time magazine a few years back, Peter Drucker got to the heart of things. "I will tell you a secret. Deal-making beats working. Deal-making is exciting and fun, and working is grubby. Running anything is primarily an enormous amount of grubby detail work. Deal-making is romantic, sexy. That's why you have deals that make no sense." In making acquisitions, we have a further advantage. As payment, we can offer sellers a stock backed by an extraordinary collection of outstanding businesses. An individual or a family wishing to dispose of a single fine business, but also wishing to defer personal taxes indefinitely, is apt to find Berkshire stock a particular comfortable holding. I believe, in fact, that this calculus played an important part in the two acquisitions, for which we paid shares in 1995. Beyond that, sellers sometimes care about placing their companies in a corporate home that will both endure and provide pleasant, productive working conditions for their managers. Here again, Berkshire offers something special. Our managers operate with extraordinary autonomy. Additionally, our ownership structure enables sellers to know that when I say we are buying to keep, the promise means something. For our part, we like dealing with owners who care what happens to their companies and people. A buyer is likely to find fewer unpleasant surprises dealing with that type of seller than with one simply auctioning off his business. In addition to the foregoing being an explanation of our acquisition style, it is, of course, a not-so-subtle sales pitch. If you own or represent a business earning $25 million or more before tax, and it fits the criteria listed on page 23, just give me a call. Our discussion will be confidential. And if you aren't interested now, file our proposition in the back of your mind. We are never going to lose our appetite for buying companies with good economics and excellent management. Concluding this little dissertation on acquisitions, I can't resist repeating a tale told me last year by a corporate executive. The business he grew up in was a fine one, with a long-time record of leadership in its industry. Its main product, however, was distressingly glamourless. So several decades ago, the company hired a management consultant who naturally advised diversification, the then current fad. Focus was not yet in style. Before long, the company acquired a number of businesses, each after the consulting firm had gone through a long and expensive acquisition study. And the outcome? Said the executive sadly. When we started, we were getting 100% of our earnings from the original business. After 10 years, we were getting 150%. Helzberg's Diamond Shops. A few years back, management consultants popularized a technique called management by walking around, MBWA. At Berkshire, we've instituted ABWA, acquisitions by walking around. In May 1994, a week or so after the annual meeting, I was crossing the street at 58th and 5th Avenue in New York when a woman called out my name. I listened as she told me she'd been to, and had enjoyed, the annual meeting. A few seconds later, a man who'd heard the woman stop me did so as well. He turned out to be Barnett Helzberg, Jr., who owned 4 shares of Berkshire and had also been at our meeting. In our few minutes of conversation, Barnett said he had a business we might be interested in. When people say that, it usually turns out they have a lemonade stand with potential, of course, to quickly grow into the next Microsoft. So I simply asked Barnett to send me particulars. That, I thought to myself, will be the end of that. Not long after, Barnett sent me the financial statements of Helzberg's Diamond Shops. The company had been started by his grandfather in 1915 from a single store in Kansas City, and had developed by the time we met into a group with 134 stores in 23 states. Sales had grown from $10 million in 1974 to $53 million in 1984, and $282 million in 1994. We weren't talking lemonade stands. Barnett, then 60, loved the business but also wanted to feel free of it. In 1988, as a step in that direction, he had brought in Jeff Comment, formerly president of Wanamakers, to help him run things. The hiring of Jeff turned out to be a home run, but Barnett still found that he couldn't shake a feeling of ultimate responsibility. Additionally, he owned a valuable asset that was subject to the vagaries of a single, very competitive industry, and he thought it prudent to diversify his family's holdings. Berkshire was made to order for him. It took us a while to get together on price, but there was never any question in my mind that, first, Helzberg's was the kind of business that we wanted to own, and, second, Jeff was our kind of manager. In fact, we would not have bought the business if Jeff had not been there to run it. Buying a retailer without good management is like buying the Eiffel Tower without an elevator. We completed the Helzberg purchase in 1995 by means of a tax-free exchange of stock, the only kind of transaction that interested Barnett. Though he was certain under no obligation to do so, Barnett shared a meaningful part of his proceeds from the sale with a large number of his associates. When someone behaves that generously, you know you are going to be treated right as a buyer. The average Helzberg store has annual sales of about $2 million, far more than competitors operating similarly sized stores achieve. This superior per-store productivity is the key to Helzberg's excellent profits. If the company continues its first-rate performance, and we believe it will, it could grow rather quickly to several times its present size. Helzberg's, it should be added, is an entirely different sort of operation from Borsheim's, our Omaha jewelry business, and the two companies will operate independently of each other. Borsheim's had an excellent year in 1995, with sales up 11.7%. Susan Jacques, its 36-year-old CEO, had an even better year, giving birth to her second son at the start of the Christmas season. Susan has proved to be a terrific leader in the 2 years since her promotion. R.C. Willey Home Furnishings. It was Nebraska Furniture Mart's Irv Blumkin who did the walking around in the case of R.C. Willey, long the leading home furnishings business in Utah. Over theirs, Irv had told me about the strengths of that company, and he had also told Bill Child, CEO of R.C. Willey, how pleased the Blumkin family had been with its Berkshire relationship. So in early 1995, Bill mentioned to Irv that for estate tax and diversification reasons, he and the other owners of R.C. Willey might be interested in selling. From that point forward, things could not have been simpler. Bill sent me some figures, and I wrote him a letter indicating my idea of value. We quickly agreed on a number, and found our personal chemistry to be perfect. By mid-year, the merger was completed. R.C. Willey is an amazing story. Bill took over the business from his father-in-law in 1954, when sales were about $250,000. From this tiny base, Bill employed Mae West's philosophy. It's not what you've got, it's what you do with what you've got. Aided by his brother Sheldon, Bill has built the company to its 1,995 sales, volume of $257 million, and it now accounts for over 50% of the furniture business in Utah. Like Nebraska Furniture Mart, R.C. Willey sells appliances, electronics, computers, and carpets in addition to furniture. Both companies have about the same sales volume, but NFM gets all of its business from one complex in Omaha, whereas R.C. Willey will open its 6th major store in the next few months. Retailing is a tough business. During my investment career, I have watched a large number of retailers enjoy terrific growth and superb returns on equity for a period, and then suddenly nosedive, often all the way into bankruptcy. This shooting star phenomenon is far more common in retailing than it is in manufacturing or service businesses. In part, this is because a retailer must stay smart, day after day. Your competitor is always copying and then topping whatever you do. Shoppers are meanwhile beckoned in every conceivable way to try a stream of new merchants. In retailing, to coast is to fail. In contrast to this have-to-be smart everyday business, there is what I call the have-to-be-smart once business. For example, if you were smart enough to buy a network TV station very early in the game, you could put in a shiftless and backward nephew to run things, and the business would still do well for decades. You'd do far better, of course, if you put in Tom Murphy, but you could stay comfortably in the black without him. For a retailer, hiring that nephew would be an express ticket to bankruptcy. The 2 retailing businesses we purchased this year are blessed with terrific managers who love to compete and have done so successfully for decades. Like the CEOs of our other operating units, they will operate autonomously. We want them to feel that the businesses they run are theirs. This means no second-guessing by Charlie and me. We avoid the attitude of the alumnus, whose message to the football coach is, "I'm 100% with you, win or tie." Our basic goal as an owner is to behave with our managers as we like our owners to behave with us. As we add more operations, I'm sometimes asked how many people I can handle reporting to me. My answer to that is simple. If I have one person reporting to me and he is a lemon, that's one too many, and if I have managers like those we know have, the number can be almost unlimited. We are lucky to have Bill and Sheldon associated with us, and we hope that we can acquire other businesses that bring with them managers of similar caliber. Geico Corporation. Right after year-end, we completed the purchase of 100% of Geico, the 7th largest auto insurer in the United States, with about 3.7 million cars insured. I've had a 45-year association with Geico, and though the story has been told before, it's worth a short recap here. I attended Columbia University's business school in 1950-51, not because I cared about the degree it offered, but because I wanted to study under Ben Graham, then teaching there. The time I spent in Ben's classes was a personal high, and quickly induced me to learn all I could about my hero. I turned first to Who's Who in America, finding there, among other things, that Ben was chairman of Government Employees Insurance Company, to me an unknown company in an unfamiliar industry. A librarian next referred me to Best's Fire and Casualty Insurance Manual, where I learned that Geico was based in Washington, D.C. So, On a Saturday in January, 1951, I took the train to Washington and headed for Geico's downtown headquarters. To my dismay, the building was closed, but I pounded on the door until a custodian appeared. I asked this puzzled fellow if there was anyone in the office I could talk to, and he said he'd seen one man working on the 6th floor. And thus I met Lorimer Davidson, assistant to the president, who was later to become CEO. Though my only credentials were that I was a student of Graham's, Davy graciously spent 4 hours or so showering me with both kindness and instruction. No one has ever received a better half-day course in how the insurance industry functions, nor in the factors that enable one company to excel over others. As Davy made clear, Geico's method of selling direct marketing gave it an enormous cost advantage over competitors that sold through agents, a form of distribution so ingrained in the business of these insurers that it was impossible for them to give it up. After my session with Davy, I was more excited about Geico than I have ever been about a stock. When I finished at Columbia some months later and returned to Omaha to sell securities, I naturally focused almost exclusively on Geico. My first sales call on my Aunt Alice, who always supported me 100%, was successful. But I was then Askany, unpolished 20-year-old who looked about 17, and my pitch usually failed. Undaunted, I wrote a short report late in 1951 about Geico for the Security I Like Best column in the Commercial and Financial Chronicle, a leading financial publication of the time. More important, I bought stock for my own account. You may think this odd, but I have kept copies of every tax return I filed, starting with the return for 1944. Checking back, I find that I purchased Geico shares on 4 occasions during 1951, the last purchase being made on September 26. This pattern of persistence suggests to me that my tendency toward self-intoxication was developed early. I probably came back on that September day from unsuccessful trying to sell some prospect and decided, despite my already having more than 50% of my net worth in Geico, to load up further. In any event, I accumulated 350 shares of Geico during the year, at a cost of $10,282. At year-end, this holding was worth $13,125, more than 65% of my net worth. You can see why Geico was my first business love. Furthermore, just to complete this stroll down memory lane, I should add that I earned most of the funds I used to buy Geico shares by delivering the Washington Post, the chief product of a company that much later made it possible for Berkshire to turn $10 million into $500 million. Alas, I sold my entire Geico position in 1952 for $15,259, primarily to switch into Western Insurance securities. This act of infidelity can partially be excused by the fact that Western was selling for slightly more than 1 times its current earnings, AP, ratio that for some reason caught my eye. But in the next 20 years, the Geico stock I sold grew in value to about $1.3 million, which taught me a lesson about the inadvisability of selling a stake in an identifiably wonderful company. In the early 1970s, after Davy retired, the executives running Geico made some serious errors in estimating their claims costs, a mistake that led the company to underprice its policies and that almost caused it to go bankrupt. The company was saved only because Jack Byrne came in as CEO in 1976 and took drastic remedial measures. Because I believed both in Jack and in Geico's fundamental competitive strength, Berkshire purchased a large interest in the company during the second half of 1976 and also made smaller purchases later. By year-end 1980, we had put $45.7 million into Geico and owned 33.3% of its shares. During the next 15 years, we did not make further purchases. Our interest in the company, nonetheless, grew to about 50% because it was a big repurchaser of its own shares. Then, in 1995, we agreed to pay $2.3 billion for the half of the company we didn't own. That is a steep price. But it gives us full ownership of a growing enterprise whose business remains exceptional for precisely the same reasons that prevailed in 1951. In addition, Geico has 2 extraordinary managers. Tony Nicely, who runs the insurance side of the operation, and Lou Simpson, who runs investments. Tony, 52, has been with Geico for 34 years. There's no one I would rather have managing Geico's insurance operation. He has brains, energy, integrity, and focus. If we're lucky, he'll stay another 34 years. Lou runs investments just as ably. Between 1,980 and 1,995, the equities under Lou's management returned an average of 22.8% annually versus 15.7% for the S&P. Lou takes the same conservative, concentrated approach to investments that we do at Berkshire, and it is an enormous plus for us to have him on board. One point that goes beyond Lou's Geico work. His presence on the scene assures us that Berkshire would have an extraordinary professional immediately available to handle its investments if something were to happen to Charlie and me. Geico, of course, must continue both to attract good policyholders and keep them happy. It must also reserve and price properly. But the ultimate key to the company's success is its rock-bottom operating costs, which virtually no competitor can match. In 1995, moreover, Tony and his management team pushed underwriting and loss adjustment expenses down further to 23.6% of premiums, nearly 1 percentage point below 1,994's ratio. In business, I look for economic castles protected by unbreachable moats. Thanks to Tony and his management team, Geico's moat widened in 1995. Finally, let me bring you up to date on Davey. He's now 93 and remains my friend and teacher. He continues to pay close attention to Geico and has always been there when the company's CEOs Jack Byrne, Bill Snyder, and Tony have needed him. Our acquisition of 100% of Geico caused Davey to incur a large tax. Characteristically, he still warmly supported the transaction. Davey has been one of my heroes for the 45 years I've known him, and he's never let me down. You should understand that Berkshire would not be where it is today if Davey had not been so generous with his time on a cold Saturday in 1951. I've often thanked him privately, but it is fitting that I use this report to thank him on behalf of Berkshire shareholders. Insurance operations. In addition to acquiring Geico, we enjoyed other favorable developments in insurance during 1995. As we've explained in past reports, what counts in our insurance business is, first, the amount of float we generate, and second, its cost to us. Float is money we hold but don't own. In an insurance operation, float arises because most policies require that premiums be prepaid and, more importantly, because it usually takes time for an insurer to hear about and resolve loss claims. Typically, the premiums that an insurer takes in do not cover the losses and expenses it must pay. That leaves it running an underwriting loss, and that loss is the cost of float. An insurance business is profitable over time if its cost of float is less than the cost the company would otherwise incur to obtain funds. But the business has a negative value if the cost of its float is higher than market rates for money. As the numbers in the following table show, Berkshire's insurance business has been a huge winner. For the table, we have calculated our float, which would generate in exceptional amounts relative to our premium volume, by adding loss reserves, loss adjustment reserves, funds held under reinsurance, assumed and unearned premium reserves, and then subtracting agents' balances, prepaid acquisition costs, prepaid taxes, and deferred charges applicable to assumed reinsurance. Our cost of float is determined by our underwriting loss or profit. In those years when we have had an underwriting profit, such as the last 3, our cost off float has been negative, which means we have calculated our insurance earnings by adding underwriting profit to float income. Since 1967, when we entered the insurance business, our float has grown at an annual compounded rate of 20.7%. In more years than not, our cost of funds has been less than nothing. This access to free money has boosted Berkshire's performance in a major way. Any company's level of profitability is determined by 3 items. 1. What its assets earn. 2. What its liabilities cost. And 3. Its utilization of leverage. That is, the degree to which its assets are funded by liabilities rather than by equity. Over the years, we have done well on point 1, having produced high returns on our assets. But we have also benefited greatly to a degree that is not generally well understood, because our liabilities have cost us very little. An important reason for this low cost is that we have obtained float on very advantageous terms. The same cannot be said by many other property and casualty insurers, who may generate plenty of float, but at a cost that exceeds what the funds are worth to them. In those circumstances, leverage becomes a disadvantage. Since our float has cost us virtually nothing over the years, it has in effect served us equity. Of course, it differs from true equity in that it doesn't belong to us. Nevertheless, let's assume that instead of our having $3.4 billion of float at the end of 1994, we had replaced it with $3.4 billion of equity. Under this scenario, we would have owned no more assets than we did during 1995. We would, however, have had somewhat lower earnings because the cost of float was negative last year. That is, our float threw off profits. And, of course, to obtain the replacement equity, we would have needed to sell many new shares of Berkshire. The net result: more shares, equal assets, and lower earnings would have materially reduced the value of our stock. So you can understand why float wonderfully benefits a business if it is obtained at a low cost. Our acquisition of Geico will immediately increase our float by nearly $3 billion, with additional growth almost certain. We also expect Geico to operate at a decent underwriting profit in most years, a fact that will increase the probability that our total float will cost us nothing. Of course, we paid a very substantial price for the Geico float, whereas virtually all of the gains in float depicted in the table were developed internally. Our enthusiasm over 1995's insurance results must be tempered once again, because we had our third straight year of good fortune in the supercat business. In this operation, we sell policies that insurance and reinsurance companies buy to protect themselves from the effects of mega catastrophes. Since truly major catastrophes occur infrequently, our supercat business can be expected to show large profits in most years, but occasionally to record a huge loss. In other words, the attractiveness of our supercat business will take many years to measure. We know that the results of years like the past 3 will be at least partially offset by some truly terrible year in the future. We just hope that, partially, turns out to be the proper adverb. There were plenty of catastrophes last year, but no supercats of the insured variety. The Southeast had a close call when Opal, sporting winds of 150 miles per hour, hovered off Florida. However, the storm abated before hitting land, and so a second Andrew was dodged. For insurers, the Kobe earthquake was another close call. The economic damage was huge, perhaps even a record, but only a tiny portion of it was insured. The insurance industry won't always be that lucky. Ajit Jain is the guiding genius of our supercat business, and writes important non-cat business as well. In insurance, the term catastrophe is applied to an event, such as a hurricane or earthquake, that causes a great many insured losses. The other deals Ajit enters into usually cover only a single large loss. A simplified description of 3 transactions from last year will illustrate both what I mean and Ajit's versatility. We insured 1. The life of Mike Tyson for a sum that is large initially, and that fight by fight, gradually declines to 0 over the next few years. 2. Lloyd's against more than 225 of its names, dying during the year. And 3. The launch, and a year of orbit of 2 Chinese satellites. Happily, both satellites are reorbiting, the Lloyd's folk avoided abnormal mortality, and if Mike Tyson looked any healthier, no one would get in the ring with him. Berkshire is sought out for many kinds of insurance, both supercat and large single risk, because 1. Our financial strength is unmatched, and insureds know we can and will pay our losses under the most adverse of circumstances. 2. We can supply a quote faster than anyone in the business. And 3. We will issue policies with limits larger than anyone else is prepared to write. Most of our competitors shave extensive reinsurance treaties and lay off much of their business. While this helps them avoid shock losses, it also hurts their flexibility and reaction time. As you know, Berkshire moves quickly to seize investment and acquisition opportunities. In insurance, we respond with the same exceptional speed. In another important point, large coverages don't frighten us but, on the contrary, intensify our interest. We have offered a policy under which we could have lost $1 billion. The largest coverage that a client accepted was $400 million. We will get hit from time to time with large losses. Charlie and I, however, are quite willing to accept relatively volatile results in exchange for better long-term earnings than we would otherwise have had. In other words, we prefer a lumpy 15% to a smooth 12%. Since most managers opt for smoothness, we are left with a competitive advantage that we try to maximize. We do, though, monitor our aggregate exposure in order to keep our worst case at a level that leaves us comfortable. Indeed, our worst case from a once-in-a-century supercat is far less severe relative to net worth than that faced by many well-known primary companies writing great numbers of property policies. These insurers don't issue single huge limit policies as we do, but their small policies, in aggregate, can create a risk of staggering size. The big one would blow right through the reinsurance covers of some of these insurers, exposing them to uncapped losses that could threaten their survival. In our case, losses would be large, but capped at levels we could easily handle. Prices are weakening in the supercat field. That is understandable considering the influx of capital into the reinsurance business a few years ago, and the natural desire of those holding the capital to employ it. No matter what others may do, we will not knowingly write business at inadequate rates. We unwittingly did this in the early 1970s, and, after more than 20 years, regularly receive significant bills stemming from the mistakes of that era. My guess is that we will still be getting surprises from that business 20 years from now. A bad reinsurance contract is like hell, easy to enter and impossible to exit. I actively participated in those early reinsurance decisions, and Berkshire paid a heavy tuition for my education in the business. Unfortunately, reinsurance students can't attend school on scholarship. Geico, incidentally, suffered a similar disastrous experience in the early 1980s, when it plunged enthusiastically into the writing of reinsurance and large risks. Geico's folly was brief, but it will be cleaning things up for at least another decade. The well-publicized problems at Lloyd's further illustrate the perils of reinsurance, and also underscore how vital it is that the interests of the people who write insurance business be aligned on the downside as well as the upside, with those of the people putting up the capital. When that kind of symmetry is missing, insurers almost invariably run into trouble, though its existence may remain hidden for some time. A small apocryphal story about an insurance CEO who was visited by an analyst tells a lot about this industry. To the analyst's questions about his business, the CEO had nothing but gloomy answers. Rates were ridiculously low. The reserves on his balance sheet weren't adequate for ordinary claims, much less those likely to arise from asbestos and environmental problems. Most of his reinsurers had long since gone broke, leaving him holding the sack. But then the CEO brightened. "Still, things could be a lot worse," he said. "It could be my money. At Berkshire, it's our money." Berkshire's other insurance operations, though relatively small, performed magnificently in 1995. National Indemnity's traditional business had a combined ratio of 84.2, and developed, as usual, a large amount of float compared to premium volume. Over the last 3 years, this segment of our business, run by Don Worster, has had an average combined ratio of 85.6. Our home state operation, managed by Rod Eldred, grew at a good rate in 1995 and achieved a combined ratio of 81.4. Its 3-year combined ratio is an amazing 82.4. Berkshire's California workers' compensation business, run by Brad Kinsler, faced fierce price cutting in 1995 and lost a great many renewals when we refused to accept inadequate rates. Though this operation's volume dropped materially, it produced an excellent underwriting profit. Finally, John Kaiser, at Central States Indemnity, continues to do an extraordinary job. His premium volume was up 23% in 1995, and underwriting profit grew by 59%. Ajit, Don, Rod, Brad and John are all under 45. An embarrassing fact demolishing my theory that managers only hit their stride after they reach 70. To sum up, we entered 1995 with an exceptional insurance operation of moderate size. By adding Geico, we entered 1996 with a business still better in quality, much improved in its growth prospects, and doubled in size. More than ever, insurance is our core strength. Sources of reported earnings. The table below shows the main sources of Berkshire's reported earnings. In this presentation, purchase premium charges are not assigned to the specific business to which they apply, but are instead aggregated and shown separately. This procedure lets you view the earnings of our businesses as they would have been reported had we not purchased them. This form of presentation seems to us to be more useful to investors and managers than one utilizing GAAP, which requires purchase premiums to be charged off, business by business. The total earnings we show in the table are, of course, identical to the GAAP total in our audited finance statements. 1. Includes R.C. Willey from the 29th of June 1995. 2. Includes Helzberg's from the 30th of April 1995. 3. Jewelry earnings were included in other in 1994. 4. Excludes interest expense of finance businesses. A large amount of information about these businesses is given on pages 41 to 52, where you will also find our segment earnings reported on a GAAP basis. In addition, On pages 57 to 63, we have rearranged Berkshire's financial data into 4 segments on a non-GAAP basis, a presentation that corresponds to the way Charlie and I think about the company. Our intent is to supply you with the financial information that we would wish you to give us if our positions were reversed. At Berkshire, we believe in Charlie's dictum, just tell me the bad news, the good news will take care of itself, and that is the behavior we expect of our managers when they are reporting to us. Consequently, I also owe you Berkshire's owners a report on 3 operations that, though they continued to earn decent, or better, returns on invested capital, experienced a decline in earnings last year. Each encountered a different type of problem. Our shoe business operated in an industry that suffered depressed earnings throughout last year, and many of our competitors made only marginal profits or worse. That means we at least maintained, and in some instances widened, our competitive superiority. So I have no doubt that our shoe operations will climb back to top-grade earnings in the future. In other words, though the turn has not yet occurred, we believe you should view last year's figures as reflecting a cyclical problem, not a secular one. The Buffalo News, though still doing very well in comparison to other newspapers, is another story. In this case, industry trends are not good. In the 1991 annual report, I explained that newspapers had lost a notch in their economic attractiveness from the days when they appeared to have a bulletproof franchise. Today, the industry retains its excellent economics, but has lost still another notch. Over time, we expect the competitive strength of newspapers to gradually erode, though the industry should nevertheless remain a fine business for many years to come. Berkshire's most difficult problem is WorldBook, which operates in an industry beset by increasingly tough competition from CD-ROM and online offerings. True, we are still profitable, a claim that perhaps no other print encyclopedia can make, but our sales and earnings trends have gone in the wrong direction. At the end of 1995, WorldBook made major changes in the way it distributes its product, stepped up its efforts with electronic products, and sharply reduced its overhead costs. It will take time for us to evaluate the effects of these initiatives, but we are confident they will significantly improve our viability. All of our operations, including those whose earnings fell last year, benefit from exceptionally talented and dedicated managers. Were we to have the choice of any other executives now working in their industries, there is not one of our managers we would replace. Many of our managers don't have to work for a living, but simply go out and perform every day for the same reason that wealthy golfers stay on the tour. They love both doing what they do and doing it well. To describe them as working may be a misnomer. They simply prefer spending much of their time on a productive activity at which they excel to spending it on leisure activities. Our job is to provide an environment that will keep them feeling this way, and so far we seem to have succeeded. Thinking back over the 1965 to 95 period, I can't recall that a single key manager has left Berkshire to join another employer. Common stock investments. Below we present our common stock investments. Those with a market value of more than $600 million are itemized. We continue in our Rip Van Winkle mode. 5 of our 6 top positions at year-end 1994 were left untouched during 1995. The 6th was American Express, in which we increased our ownership to about 10%. In early 1996, 2 major events affected our holdings. First, our purchase of the Geico stock we did not already own caused that company to be converted into a wholly owned subsidiary. Second, we exchanged our Cap Cities shares for a combination of cash and Disney stock. In the Disney merger, Cap Cities shareholders had a choice of actions. If they chose, they could exchange each of their Cap Cities shares for 1 share of Disney stock plus $65. Or, they could ask for, though not necessarily get all cash or all stock, with their ultimate allotment of each depending on the choices made by other shareholders and certain decisions made by Disney. For our 20 million shares, we sought stock, but do not know, as this report goes to press, how much we were allocated. We are certain, however, to receive something over 20 million Disney shares. We have also recently bought Disney stock in the market. One more bit of history. I first became interested in Disney in 1966, when its market valuation was less than $90 million, even though the company had earned around $21 million pre-tax in 1965 and was sitting with more cash than debt. At Disneyland, the $17 million Pirates of the Caribbean ride would soon open. Imagine the excitement, a company selling at only 5 times rides. Duly impressed, Buffett Partnership Limited bought a significant amount of Disney stock at a split-adjusted price of 31 cents per share. That decision may appear brilliant, given that the stock now sells for $66, but your chairman was up to the task of nullifying it. In 1967 I sold out at 48 cents per share. Oh well, we're happy to be once again a large owner of a business with both unique assets and outstanding management. Convertible preferred stocks. As many of you will remember, Berkshire made 5 private purchases of convertible preferred stocks during the 1987 to 91 period, and the time seems right to discuss their status. Here are the particulars. 1. Proceeds from sale of common we received through conversion in 1995. 2. The 31st of December 2095 value of common we received through conversion in 1991. 3. Includes $140 we received in 1995 from partial redemption. In each case, we had the option of sticking with these preferreds as fixed income securities or converting them into common stock. Initially, their value to us came primarily from their fixed income characteristics. The option we had to convert was a kicker. Our $300 million private purchase of American Express Perks described in the 1991 annual report is not included in the table because that security was a modified form of common stock whose fixed income characteristics contributed only a minor portion of its initial value. 3 years after we bought them, the perks automatically were converted to common stock. In contrast, the 5 securities in the table were set to become common stocks only if we wished them to. A crucial difference. When we purchased our convertible securities, I told you that we expected to earn after-tax returns from them that moderately exceeded what we could earn from the medium-term fixed income securities they replaced. We beat this expectation, but only because of the performance of a single issue. I also told you that these securities, as a group, would not produce the returns we can achieve when we find a business with wonderful economic prospects. Unfortunately, that prediction was fulfilled. Finally, I said that, under almost any conditions, we expect these preferreds to return us our money plus dividends. That's one I would like to have back. Winston Churchill once said that, eating my words has never given me indigestion. My assertion, however, that it was almost impossible for us to lose money on our preferreds has caused me some well-deserved heartburn. Our best holding has been Gillette, which we told you from the start was a superior business. Ironically though, this is also the purchase in which I made my biggest mistake of a kind, however, never recognized on financial statements. We paid $600 million in 1989 for Gillette preferred shares that were convertible into 48 million, split-adjusted, common shares. Taking an alternative route with the $600 million, I probably could have purchased 60 million shares of common from the company. The market on the common was then about $10.50, and given that this would have been a huge private placement carrying important restrictions, I probably could have bought the stock at a discount of at least 5%. I can't be sure about this, but it's likely that Gillette's management would have been just as happy to have Berkshire opt for common, but I was far too clever to do that. Instead, for less than 2 years, we received some extra dividend income, the difference between the preferred's yield and that of the common, at which point the company quite properly called the issue, moving to do that as quickly as was possible. If I had negotiated for common rather than preferred, we would have been better off at year-end $1,995 by $625 million, minus the excess dividends of about $70 million. In the case of Champion, the ability of the company to call our preferred at 115% of cost forced a move out of us last August that we would rather have delayed. In this instance, we converted our shares just prior to the pending call and offered them to the company at a modest discount. Charlie and I have never had a conviction about the paper industry actually. I can't remember ever owning the common stock of a paper producer in my 54 years of investing, so our choice in August was whether to sell in the market or to the company. Champion's management had always been candid and honorable in dealing with us, and wished to repurchase common shares, so we offered our stock to the company. Our Champion capital gain was moderate, about 19% after tax from a 6-year investment, but the preferred delivered us a good after-tax dividend yield throughout our holding period. That said, many press accounts have overstated the after-tax yields earned by property casualty insurance companies on dividends paid to them. What the press has failed to take into account is a change in the tax law that took effect in 1987, and that significantly reduced the dividends received credit applicable to insurers. For details, see our 186 annual report. Our first Empire Preferred will be called on the 31st of March 1996, the earliest date allowable. We are comfortable owning stock in well-run banks, and we will convert and keep our first Empire common shares. Bob Wilmers, CEO of the company, is an outstanding banker, and we love being associated with him. Our other two preferreds have been disappointing, though the Salomon preferred has modestly outperformed the fixed income securities for which it was a substitute. However, the amount of management time Charlie and I have devoted to this holding has been vastly greater than its economic significance to Berkshire. Certainly I never dreamed I would take a new job at age 60, Salomon interim chairman. That is because of an earlier purchase of a fixed income security. Soon after our purchase of the Salomon preferred in 1987, I wrote that I had no special insights regarding the direction or future profitability of investment banking. Even the most charitable commentator would conclude that I have since proved my point. To date, our option to convert into Salomon Common has not proven of value. Furthermore, the Dow Industrials have doubled since I committed to buy the preferred, and the brokerage group has performed equally as well. That means my decision to go with Salomon because I saw value in the conversion option must be graded as very poor. Even so, the preferred has continued under some trying conditions to deliver as a fixed income security, and the 9% dividend is currently quite attractive. Unless the preferred is converted, its terms require redemption of 20% of the issue on October 31 of each year, 1995 to 99, and $140 million of our original $700 million was taken on schedule last year. Some press reports labeled this a sale, but a senior security that matures is not sold. Though we did not elect to convert the preferred that matured last year, we have 4 more bites at the conversion apple, and I believe it quite likely that we will yet find value in our right to convert. I discussed the US Air investment at length in last year's report. The company's results improved in 1995, but it still faces significant problems. On the plus side for us is the fact that our preferred is structurally well designed. For example, though we have not been paid dividends since June 1994, the amounts owed us are compounding at 5% over the prime rate. On the minus side is the fact that we are dealing with a weak credit. We feel much better about our US Air preferred than we did a year ago, but your guess is as good as mine as to its ultimate value. Indeed, considering my record with this investment, it's fair to say that your guess may be better than mine. At year-end we carried our preferred, in which there is no public market, at 60% of par, though US Air also has outstanding a junior preferred that is significantly inferior to ours in all respect, except conversion price, and that was then trading at 82% of par. As I write this, the junior issue has advanced to 97% of par. Let's hope the market is right. Overall, our preferreds have performed well, but that is true only because of one huge winner, Gillette. Leaving aside Gillette, our preferreds as a group have delivered us after-tax returns no more than equal to those we could have earned from the medium-term fixed income issues that they replaced. A proposed recapitalization. At the annual meeting, you will be asked to approve a recapitalization of Berkshire, creating 2 classes of stock. If the plan is adopted, our existing common stock will be designated as Class A common stock, and a new Class B common stock will be authorized. Each share of the B will have the rights of 1/30th of an A share with these exceptions. First, a B share will have 1/200th of the vote of an A share, rather than 1/30th of the vote. Second, the B will not be eligible to participate in Berkshire's shareholder-designated charitable contributions program. When the recapitalization is complete, each share of A will become convertible, at the holder's option and at any time, into 30 shares of B. This conversion privilege will not extend in the opposite direction. That is, holders of B shares will not be able to convert them into A shares. We expect to list the B shares on the New York Stock Exchange, where they will trade alongside the A stock. To create the shareholder base necessary for a listing, and to ensure a liquid market in the B stock, Berkshire expects to make a public offering for cash of at least $100 million of new B shares. The offering will be made only by means of a prospectus. The market will ultimately determine the price of the B shares. Their price, though, should be in the neighborhood of 1/30th of the price of the A shares. Class A shareholders who wish to give gifts may find it convenient to convert a share or 2 of their stock into Class B shares. Additionally, arbitrage-related conversions will occur if demand for the B is strong enough to push its price to slightly above 1/30th of the price of A. However, because the Class A stock will entitle its holders to full voting rights and access to Berkshire's contributions program, these shares will be superior to the Class B shares, and we would expect most shareholders to remain holders of the Class A, which is precisely what the Buffett and Munger families plan to do. except in those instances when we ourselves might convert a few shares to facilitate gifts. The prospect that most shareholders will stick to the A stock suggests that it will enjoy a somewhat more liquid market than the B. There are trade-offs for Berkshire in this recapitalization, but they do not arise from the proceeds of the offering. We will find constructive uses for the money, nor in any degree from the price at which we will sell the B shares. As I write this with Berkshire stock at $36,000, Charlie and I do not believe it undervalued. Therefore, the offering we propose will not diminish the per-share intrinsic value of our existing stock. Let me also put our thoughts about valuation more baldly. Berkshire is selling at a price at which Charlie and I would not consider buying it. What Berkshire will incur by way of the B stock are certain added costs, including those involving the mechanics of handling a larger number of shareholders. On the other hand, the stock should be a convenience for people wishing to make gifts, and those of you who have hoped for a split have gained a do-it-yourself method of bringing one about. We are making this move, though, for other reasons having to do with the appearance of expense-laden unit trusts purporting to be low-priced clones of Berkshire and sure to be aggressively marketed. The idea behind these vehicles is not new. In recent years, a number of people have told me about their wish to create an all-Berkshire investment fund to be sold at a low dollar price. But unrecently, the promoters of these investments heard out my objections and backed off. I did not discourage these people because I prefer large investors over small. Where it possible, Charlie and I would love to turn $1,000 into $3,000 for multitudes of people who would find that gain an important answer to their immediate problems. In order to quickly triple small stakes, however, we would have to just as quick turn our present market capitalization of $43 billion into $129 billion, roughly the market cap of General Electric, America's most highly valued company. We can't come close to doing that. The very best we hope for is on average to double Berkshire's per-share intrinsic value every 5 years, and we may well fall far short off that goal. In the end, Charlie and I do not care whether our shareholders own Berkshire in large or small amounts. What we wish for are shareholders of any size who are knowledgeable about our operations, share our objectives and long-term perspective, and are aware of our limitations, most particularly those imposed by our large capital base. The unit trusts that have recently surfaced fly in the face of these goals. They would be sold by brokers working for big commissions, would impose other burdensome costs on their shareholders, and would be marketed en masse to unsophisticated buyers, apt to be seduced by our past record and beguiled by the publicity Berkshire and I have received in recent years. The sure outcome, a multitude of investors destined to be disappointed. Through our creation of the B stock, a low-denomination product far superior to Berkshire-only trusts, we hope to make the clones unmerchandisable. But both present and prospective Berkshire shareholders should pay special attention to one point. Though the per-share intrinsic value of our stock has grown at an excellent rate during the past 5 years, its market price has grown still faster. The stock, in other words, has outperformed the business. That kind of market overperformance cannot persist indefinitely, neither for Berkshire nor any other stock. Inevitably, there will be periods of underperformance as well. The price volatility that results, though endemic to public markets, is not to our liking. What we would prefer instead is to have the market price of Berkshire precisely track its intrinsic value. Were the stock to do that, every shareholder would benefit during his period of ownership in exact proportion to the progress Berkshire itself made in the period. Obviously, the market behavior of Berkshire's stock will never conform to this ideal, but we will come closer to this goal than we would otherwise if our present and prospective shareholders are informed, business-oriented, and not exposed to high-commission salesmanship when making their investment decisions. To that end, we are better off if we can blunt the merchandising efforts of the unit trusts, and that is the reason we are creating the B stock. We look forward to answering your questions about the recapitalization at the annual meeting.